Greetings, everybody. This is Chuck. Welcome once again. This is the Top Tech Talk Show, where we talk all the top tech and don't talk technobabble. That's right. We're cutting right to the chase. And today we're going to talk all about what happened with the bank crisis of March 2023. This is kind of a big deal, and there are a lot of moving parts here. So some of the things that we're going to talk about are, how did the FTX meltdown start this ball rolling? And were there other factors outside of the banking industry that may have played a part? And what's going to happen now that the Silicon Valley National Bank is trying to recover and is under new ownership? For that matter, what's happening with the Signature Bank in New York? What does the New York regulators really have to do to play into this? And let's obviously talk about, just for a moment, the Federal Reserve and how the banking crisis may have actually furthered their cause. Will this affect crypto, and to what degree? Are there any friendly crypto banks left? Are we going to be able to see a surge in the crypto market because of decentralized finance? And then finally, what about Bitcoin? Bitcoin's always been top dog. Will this affect the Bitcoin market? We're going to talk about all these things and more. I'm going to host this show with some screenshots so that you can see where I got the actual news from, and then you can follow along later at home. Please be sure to like, subscribe, and tell your friends about it. We are so grateful that you tuned in to watch. My name is Chuck. Enjoy the show. Okay, let's unwrap this bank crisis just a little bit here. Silicon Valley Bank, that provided a lot of funding for startup and crypto groups, was shut down and then seized by regulators, which marked the second largest bank failure in U.S. history. In unpacking this a little bit, we see that the FDIC guaranteed the entire amount for every depositor, which meant if you had $250,000, the normal amount, you were covered. If you had $250 million, you were also covered. So this created a bit of a crisis when the smaller customers of the bank found out that there was not enough money to go around and did an old-fashioned run on the bank. What this means is liquidity issues, needing quick access to funds, and difficulty transferring those funds to other banks. What this means is that liquidity issues, when people needed access to their funds, weren't able to get it because of the withdrawing and transfer limits, meaning there just wasn't enough cash in the funnel. And this caused instability within the entire institutional banking system. Companies like Etsy and others who used SVB to create their payroll accounts or funding other ventures within their organization weren't able to process checks for payroll and other services that they owed their clients. Other large banks lost ground because of the collapse, including Signature Bank, which was taken over. These banks that were bailed out will not pay for their mismanagement of the funds. In fact, it was said by the Biden administration that they would not be using taxpayer money, but instead the deposit insurance fund fees that are paid by all banks. A little history about SVB. They were invested in a lot of treasury bonds, which don't have a huge return, and they were also giving a lot of loans out, which meant that they were exposed for a lot of capital, and other bank members found out about this and decided to withdraw their money. When a bank is holding these treasury bonds and has a run on it, they have to sell them at whatever the value is, and right now it is low. So they were taking a hit on how much money they were making on those investments. The collapse of the FTX crypto exchange probably played a large role in why other investors were coming down hard on crypto banks that were using money to transfer cryptos into cash and vice versa. When a former executive of FTX was questioned about this, he said that they believe that they will try to compete for the crypto company's business, since the three banks that were taken over were actually very crypto friendly and potentially made risky investments with those crypto exchanges. He believes this will drive competition in the market, and finding new bank partners for crypto exchanges won't be all that difficult. What's interesting is, despite this bank failure and the cryptos that were at risk, there has been new record highs in crypto trading and their funds, mainly because of people losing faith in the spot exchanges. What's interesting about SVB collapsing is that it is the second largest bank failure since 2008, and it had a lot of other exposure to different banks with investments that were out. In a small bit of irony, A funding venture for SVB failed when they tried to accumulate $1.8 billion in additional capital. Many of the capital investors in the Silicon Valley area use the SVB bank to do just that for other startup companies. Some of the effects of this collapse are going to be across the world of finance, and they're frantically searching for answers as to how this might affect the rest of the economy, outside of just the banking sectors. Since the COVID stimulation package came out, SBV and a lot of banks were flush with cash and started making more risky investments. This sent warning signs throughout the financial sectors, which caused a run on the banks as much as it did with the other regular bank clients. The fallout from this was that William Isaac, a former chairman of the FDIC, warned that this could send a string of lender collapses like the 1980s-style banking crisis. These fears have fueled a tumble of share prices on other regional U.S. banks like First Republic, Western Alliance, and PacWest Bancorp. What many people were unaware of is that the SEC was already looking into banks that were crypto-friendly and had started investigations specifically in SVB and the Signature Bank of New York. The scrutinizing of these accounts had them monitoring transactions, although few in the regulatory bodies were willing to make a comment. They said the decision by regulators to close these banks on Sunday was that they had lost faith in the management after the bank failed to provide reliable and consistent data. Many firms handling crypto or related cash must be vigilant in identifying the customers and ensuring their money flows are used for legitimate purposes. Silvergate is also being investigated for the dealings with the FTX exchange and Sam Bankman-Fried's current indictment for commingling funds with Alameda Research, their hedge fund investment group. In what appears to be just bad banking decisions by all of these firms, Mr. Wonderful himself came out and torched the idiot bankers and said that the Fed's response to SVB was nationalizing the banking system. This would be considered a crisis given that the majority of cryptos prefer the decentralized banking systems that allow them to manage their own funds. Whereas Kevin O'Leary did come out and mention that these funds were mismanaged by the banks, he also stated that the big banks should be made whole and allow the smaller banks using similar practices to just fail. In a tweet, Mr. O'Leary said the combination of a negligent board of directors and idiot management is a potential cocktail that has led with disastrous outcome. Why should the taxpayers bail them out? Never put more than 20% of any assets in one financial institution. When you're getting millions of dollars of venture capital for a startup venture, it's difficult to diversify those funds when your organization is scrambling to spend that money. Mr. O'Leary also said that by doing this, the federal government has just told me that I could take all the depositors' money and go to Las Vegas and put it on red and maybe double it or maybe lose it all. It doesn't matter to me because you, the taxpayer and the government, guarantee all my depositors. And Inside.com, a crypto newsletter, came out with a pretty good summary of all of this, saying that the SVB CEO Greg Becker and Daniel Beck sold $3.6 million and $555,000 worth of stock in their banks, respectively, just 2 weeks before they closed. However, the inquiries that were led on these early stages said that it may not lead to charges or allegations of wrongdoing. The bank, providing banking services to several crypto and tech startups, was the 16th largest bank in the United States. So to summarize the entire banking meltdown, you had big banks making loans in risky corporations, you had investments in treasury bonds that were historically low, and you were overexposed when people came to make withdrawals. Cryptos played a minor part in this equation, but they were a major exposure for all of these banks. New York specifically has been historically cracking down on crypto companies, firms, and bankers, which appears to be an effort to try to centralize and regulate cryptocurrencies inside the world's largest banking financial center. Hopefully you have an understanding about what happened here. It was really pretty plain and simple when you look at all the moving parts. I hope you stick around for the next show. We're going to have all the notes available on the podcast site as well, and you can always find those at toptechtalkshow.com. And don't forget my new radio show now. I'm on America in the Morning every morning at 5 a.m. with the Top Tech Minute, and you can find that at toptechminute.com. Please like, subscribe, and share with everybody you know. Thanks for tuning in. My name is Chuck.